After the recent Fed meeting and Jay Powell left us with little news to end the year, what does this mean moving forward into 2024? And also, potentially, there might be another year of negative returns on the books. That would be 3 consecutive years, which historically has never happened before. So before we count our blessings this November, let's find out the details and what you should do right here on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thank you for being here, and I'm back in the studio with my friend and colleague, Leslie Falconio. Leslie, it's the never-ending story about what's going on with the Fed and what they do and don't say and what happens with rates. It's all just such a big news item lately, and that's why you've been with us so much in the studio. So we had the Fed meeting recently, one more to go in December for this year. What would you say are your takeaways from this recent meeting and some of the comments that Jay Powell was making and what might be coming down the pike?
You know, that's a great question. I think that everyone was expecting this previous meeting to have sort of a hawkish pause, meaning that, you know, we knew the probability of them tightening yesterday, everyone knew was going to be very low, but they've stated in June and September that they were having, you know, probably two more rate hikes. One of them occurred in July, so they left a window open for one more, right? So that leaves us with December. One of the things that they said in this statement, though, which is a little bit different from what we've seen in the past, is the recognition of financial conditions tightening, right? And a lot of that, as we know, is because interest rates have gone up so fast and, you know, by such a large amount that we've had this tightening in financial conditions where interest rates have gone up, the equity market corrected a little bit. So they did acknowledge that, but they also, on the same account, because they can't sound overly dovish, because we're not at their target in inflation. We're trending towards that, but to truly have their inflation target be achieved, you have to see softness in the labor market. And I think what he was doing was leaving the door open for the potential of December, but he also wasn't committing to that maybe one more rate hike because he needs to see the data. And this has really been a common theme, Anthony, and you and I have talked about this a lot. It's just whether or not, I don't think the Fed really knows for sure.
Right.
So they're, like investors are, you know, probably surprised how much interest rates went up. They may surprised at how resilient the consumer has been. So they really have to have this kind of wait and see, but they're not closing the door to the potential of December hikes.
It's a bit of a conundrum in a lot of ways. You know, they're trying to cool the economy a little bit, but meanwhile, the economy continues to move in an upwards trajectory, even with jobs, as we say. So there's more reports that have to come out before the end of the year and, of course, the next Fed meeting. So given that, Leslie, and by the way, when the Fed did come out with the fact that they were keeping rates unchanged, but the comments from Powell, Treasuries did rise, yields fell, stocks rose. So there seems to be this faith in the economy from investors. But you know, we know that higher quality assets essentially may be facing, as I said in the intro, their third consecutive year of negative returns, which has never happened before. So how do you see the next few quarters maybe panning out?
Well, fortunately, we're not at the end of the year yet.
Right, still have a couple more weeks.
We still have a couple more weeks, it may not end negative, right? And I do think that one of the things as well that is really important is we have to look at the drivers as to why interest rates rose so quickly.
Right.
Okay, one of them was the market taking out, future Fed easing, right? No one's priced in, oh, they're going to tighten 4 consecutive times from now, right? It's the taking out of the easing. The fact that we have the refunding announcement actually came out and the supply amount was less than what was expected, more in the front end. The fact that we have a deficit in the U.S. is not new news. And so I think that worry has been sort of put by the side for now. And also the Bank of Japan, you know, with yield curve control, wasn't as strong or as harsh, if you will, that investors originally anticipated. So we have this sort of yields coming down. Now to the end of the year, right, we have to really see if, in fact, there's signals that fourth quarter growth could be as strong as third quarter. And you won't have the actual number by the end of the year, but you're going to start to get an idea through the labor market, through retail sales, through all these kinds of, you know, variables. You'll be able to see how strong the fourth quarter is. If it is anything like the third quarter, then highly likely that these securities are going to end up in negative interest rate territory. But here's the positive thing about that, if they should do this. They're now what we call a bit more positive convexity, in the sense that because interest rates are so high and that compounding interest, you really need to lose a lot. Interest rates have to go up by a lot before you start to drag into this negative total return. So, but we'll have to see what happens from now to the end of the year.
Yeah, exactly. It's something else, and I wanted to read something that Powell said. He speculated that Treasury yields at these kind of lofty levels. Obviously, we know that the 10-year Treasury did peak above 5% for just a little bit. It's fallen since then, the yield. But he was talking about how these lofty yield levels could help the bank, the central bank, keep monetary conditions restrictive, to wring out some of the inflationary excesses of the business cycle. Does that make sense to you in the sense of what we're seeing out there?
It does, and here's the thing: when we look at, and this goes back to where the Fed terminal rate is.
Yeah,
so
yeah.
even with all this strength, the market maybe said another 25, which should take you to say on average 5.50 Fed funds rate, right? That hasn't changed, right? But what we've seen is interest rates move up so much. That's brought financial conditions tighter. Because of that variable, the market is, sort of tightening the economy for the Fed. Right, so it alleviates them having to hike, right, in terms of slowing the economy. What you need to see, though, is that being sustained. Okay, what you don't want to see,
question, isn't it?
and what Powell doesn't want to see, is all of a sudden yields come down by a lot, the equity market takes off, and financial conditions start to loosen again, which could reignite growth and all these. So that's what he's really paying attention to. So financial conditions are tightening. He just wants to see it for a sustained period of time.
Right, and as you said before we started today, the kind of the rhetoric from Powell is like, well, we'll just have to wait and see.
Yeah,
His
rhetoric has been, we'll see.
Absolutely. And we're like, oh, what does that mean? How do I, as an investor, what do I do with that? Well, luckily we have you to talk about this with. So let me ask you, Leslie, as we're wrapping up, you've been very active with tactical allocations within fixed income. We've talked about it on this show and on the podcast you do with Dan Cassidy often this year. Just review some of what your current positions are for right now in 2023 and where you see it within maybe 2024, first 6 months or so.
Yeah, I mean, if there's any guidance in terms of our view on fixed income right now, it's particularly heading into the end of the year, is the amount of tactical we have on. I mean, we have on a plethora of fixed income right now, right? And because we just think it's just really, I mean, this year has been very difficult to predict. Economists have really underestimated the strength, as have most participants. But now that we are here and, we like going forward, and more than likely growth will slow, this is where we have our positioning. We still like the higher quality investment grade corporates, both in 7 to 10 and 1 to 3 year. We like the 5-year tips because the shoot up in real yield we think was a little bit too much. And as a matter of fact, they declined 20 basis points just yesterday, right after the Fed meeting. So we think
not surprising given what
think
treasuries have done.
As growth slows, real yields come down, so we like the tips market. Our preferreds has been a preferred allocation as well, given the fact what you're earning in terms of that carry and our expectation that growth will slow, but we don't see, and you have to be selective, of course, but we don't see a financial instability like we saw in March when it comes to the banks. And now we have things such as high yield over senior loans. That senior loans that are floating rate, given the rise in interest rates, has kind of played its part, and we like the high yield side better. But you want to do with that, Anthony, you want to be credit to credit, though, right? We're not overweighting credit versus high quality, it's credit to credit. So IG corporates, agency mortgage-backed securities, tips, preferreds, high yield over senior loans.
Excellent. Leslie, thank you so much. Lots of good stuff that our viewers can use when they're having conversations with their advisors, and obviously they're the best people to talk about what's appropriate for everyone's individual portfolios. But Leslie, thank you. Always great to have you here. Good to see you.
Thanks. You
Great.
too.
And thank you for joining us. And if you'd like more information on anything we spoke about today, make sure to visit our website at ubs.com/views. That's our insights page where all of the CIO content is located, plus more of our shows. You can also follow UBS on social media. We're on all the channels. Plus, check out our dedicated Instagram channel at UBS Trending for UBS Studios content you won't find anywhere else. And as we always say, make sure you're having conversations with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day. And remember to keep your eyes on what's trending. See you soon, everybody.